This week's market update. Company earnings dominate on both sides of the Atlantic. Politics refuses to go away as Trump tightens trade tensions. Brexit worries deepen, and various market signals suggest the market peak is closer. When there's so much going on at the macroeconomic and geopolitical level, it's easy to forget that what drives stock markets in the final analysis is company earnings. Investors own a share in the profitability and dividend-paying capacity of companies, so they can't afford to ignore the quarterly earnings cycle. This week, that cycle moves up a gear as nearly 180 companies from the S&P 500 index are slated to report figures in America. Over here, too, there's a barrage of company data. On the other side of the pond, the range of results announcements is wide. The high-flying technology sector is in focus, with numbers from Google owner Alphabet giving the week a strong start as revenues grew at the fastest pace in 4 years. Twitter and Amazon are also expected. The health of the consumer will be in the spotlight as Coca-Cola, Visa, McDonald's, Starbucks and Ford report. Meanwhile, the impact of the escalating trade war was, as expected, a key feature of Harley-Davidson's results announcement. It has reduced its margin forecast even further thanks to the impact of tariffs on its motorcycle manufacturing business. The range of results over here is just as broad, even if only a fifth of the blue chip index's constituents are due to report this week. The FTSE 100's heavily weighted sectors will be on show, with Shell and Tullow Oil flying the flag for the energy sector, Hammerson and Intu shining a light on commercial property, GlaxoSmithKline and AstraZeneca are both reporting in the pharmaceuticals sector, Sky and ITV reflect the outlook for media, and Schroders, Jupiter and Rathbone will unveil progress in the asset management business. After a stunning first quarter in the US, attention will focus on how much of a slowdown is in evidence in the April to June quarter. Forecasts suggest that earnings continued strong throughout the spring, with growth of about 20% the prediction, as tax cuts build on the underlying strength of the economy. That's slower than the 25% reported in the first 3 months, but still a stellar growth rate. Investors who've bid up share prices to close to all-time high levels will be wondering if this is as good as it gets. There's certainly plenty for them to worry about outside the boardroom. Donald Trump has followed up on his chaotic visit to Europe with a continued barrage of provocation. In recent days, he's lashed out at the Federal Reserve, smashing convention by criticising the independent central bank's monetary policy. Trump has talked the dollar down before, knowing how a strong US currency creates headwinds for American businesses. The dollar has risen more than 7% from its February low, and although it remains 8% below its 2016 peak, the president is doing all he can to drag it down to a more competitive level. In particular, he's unhappy with the dollar's strength against the Chinese renminbi, which has been the worst performing emerging market currency over the past month. It's down nearly 5%. That reflects trade war fears as well as slower growth and tighter credit. The weakening Chinese currency is a concern outside the White House too, as it evokes memories of the market turbulence in 2015, which was triggered by a slide in the renminbi and by ill-thought-through attempts by Beijing to manage the equity and currency markets. Trump's trade rhetoric is not restricted to currencies. He's also warned that he's preparing to include all $500 billion of Chinese exports to the US in his tariff target. Meanwhile, he's ratcheted up the tension with Europe by describing the EU as a foe that has taken advantage of the US on trade. Having imposed tariffs on steel and aluminium, the US administration is investigating whether car imports from Europe represent a threat to US national security. Jean-Claude Juncker, the president of the European Commission, is in Washington this week with Trade Commissioner Cecilia Malmström to air EU concerns with the president. Meanwhile, Brexit looks as far from resolution as ever, as British MPs prepare to begin their long summer recess. With the clock ticking towards a planned October withdrawal treaty deal with the EU, government ministers will be working throughout the summer to try and finalise a deal. The signs are not looking good. New Foreign Secretary Jeremy Hunt warned this week that the chance of a disorderly no-deal exit next March is rising. At the same time, Michel Barnier, the EU's chief Brexit negotiator, has ruled that Theresa May's latest financial services plan is a non-starter. Britain has already relegated services in its list of priorities, focusing on trading goods, but its desire to build on an equivalence regime that currently provides the US and Singapore with access to the EU bloc has been rejected as an attack on Brussels' decision-making autonomy. Having reached $1.43 in April on hopes for a soft Brexit deal that protected Britain's access to Europe's customs union and single market, currency traders are now taking a dimmer view of the outlook for Britain, with the pound down to $1.31. Elsewhere in the markets, various signals are flashing at least amber, if not red yet, for investors. The first of these is a so-called flattening in the yield curve, which is historically a sign of impending recession. The situation this describes is a narrowing of the usual gap between the yield on short-term bonds and that on longer-term issues. In normal circumstances, bonds that are further away from maturity offer investors a higher yield as compensation for inflation and for default risk. The yield curve, in other words, is upward sloping. But if short-term yields rise as interest rates increase, or long-term yields fall because investors are worried about a lack of inflation or of approaching recession, then the curve flattens or in rare cases becomes downward sloping. With longer-term yields now just 1/4% higher than short-term bond yields, the prospect of an inverted yield curve with all that might imply about a looming recession is starting to worry investors. Another worrying signal for investors is the fact that in the US it's now possible to earn more from tying up your money for just 3 months in US Treasury bills, a kind of proxy for cash, than it is on the average US share. This has not been the case for the past 10 years or so since the financial crisis, and it suggests that investors might feel more relaxed about being out of the market than when shares were the only way to earn an acceptable income. With stock markets pretty highly rated, any reason not to be invested in the market is potentially bad news. One further sign that markets may be running ahead of themselves, in particular the US, is the relative performance of both momentum and growth styles versus the cheap stocks favoured by value investors, and the outperformance of the US over other markets. The explanation for this style and geographical bias is almost wholly accounted for by the performance of the so-called FANGs, the high-flying technology shares that have driven the market higher recently. A narrowing in market leadership like this is very often a sign that the top is in sight. Just half a dozen US technology companies now account for $1 in every $6 of the US stock market's value. That's a remarkable degree of concentration, and it points to extremely high expectations for these companies. So far, they've delivered. But as Netflix showed last week, the slightest disappointment, in its case slightly lower subscriber numbers than hoped for, can result in an outsized market overreaction. Netflix shares fell by 14% in one day as investors worried that they've been overpaying for its debt-fueled growth. And finally, the oil price has received a boost from an exchange of intemperate views between Iran's President Rouhani and America's President Trump. Rouhani warned on Sunday that the US should not play with fire when it came to dealing with his country. Trump responded in kind with capital letters and exclamation marks on Twitter, threatening heavy consequences if Iran continued with what he called demented words of violence and death. The cost of Brent crude rose by 1.5% on Monday to $74.26, while the US WTI contract was 1% higher at $69.11. The rally follows 3 weeks of weakness on signs of increasing supplies and fears that trade tensions will hit economic growth.